If you have ever looked at the number on your Social Security statement and thought it should be higher, you are probably right. Not because the system is cheating you, but because the formula that calculates your benefit has 5 specific levers built into it, and most people never touch a single one. Some of them can add hundreds of dollars a month to your check permanently, and one of them involves an error that Social Security itself has acknowledged affects billions of dollars in wages, and the only person who will ever catch it is you. That is what this video is. And stay to the end, because the 5th strategy is the one nobody talks about, and it is the only one on this list you can act on in a single afternoon. My name is Nolan Carter. I track the rules and formulas buried inside government systems, the ones that quietly decide how much of the money you earned actually reaches your hands. I believe that if 5 levers exist inside the Social Security formula that can change your check, you deserve to know all 5 in plain language before you file. If this is the kind of information you want reaching you before it costs you something, subscribe right now. This channel covers exactly this, the financial rules and calculation details that rarely get explained clearly until the money has already been set. Now, before the 5 strategies, I want to spend 2 minutes showing you how Social Security actually calculates your benefit. Because once you see the formula, every strategy on this list will make immediate sense. Here is the short version. Social Security looks at every year you worked and paid into the system. It takes your 35 highest earning years, adjusts the older ones for wage inflation so they are comparable to today's dollars, adds them up, and divides by 420, which is 35 years times 12 months. That gives you a number called your average indexed monthly earnings, your AIME. Think of it as your average monthly paycheck across your best 35 years. Then it runs that number through a progressive formula. The first $1,286 of your AIM gets replaced at 90%. The next portion, between $1,286 and $7,749, gets replaced at 32%. Anything above $7,749 gets replaced at just 15%. Those dollar thresholds are called bend points, and they are the 2,026 figures. Add the 3 pieces together and you get your primary insurance amount, your PIA, which is your monthly benefit, at full retirement age. Here is what that looks like in real dollars. Say your average index monthly earnings work out to $5,000. The first $1,286 at 90% gives you $1,157. The remaining $3,714 at 32% gives you $1,188. Total PIA, roughly $2,345 a month at full retirement age. If you claim at 62, that drops to about $1,642 permanently. If you delay to 70, it rises to about $2,908 permanently, and inflation adjusted for life. That is the entire formula. 5 levers sit inside it. Let me show you each one. Strategy 1, delay your benefit. This is the most powerful single lever you have. For every year you delay past your full retirement age up to age 70, your benefit grows by approximately 8% per year. That is not a one-time bonus. It is a permanent increase to a check that is inflation adjusted for the rest of your life. Let me put specific numbers on it. Say your benefit at full retirement age is $2,500 a month. If you claim at 62, that drops to roughly $1,750. If you delay to 70, it rises to roughly $3,100. That is a difference of $1,350 every single month between the earliest and the latest claiming age. Over a 20-year retirement, that gap adds up to more than $320,000. Now, I am not telling you that everyone should delay to 70. If you are in poor health, if you need the income now, if your situation requires the money today, claiming earlier may be the right decision. But if you are healthy, if you have savings or other income to bridge the gap, and if you are looking for the single largest guaranteed increase to your lifetime income, delaying is the lever that moves the most money. Strategy 2, fill the 35-year window. Now that you know Social Security averages your 35 highest earning years, here is what happens when you do not have 35. If you worked 30 years, Social Security does not average over 30. It still divides by 420, which means 5 years of zero get averaged in alongside your real earnings, and every one of those zeros drags your average down. Here's what that costs in real dollars. Adding just 1 year of $50,000 in earnings to replace a zero raises your average index monthly earnings by roughly $119. Run that through the formula at the 32% tier, and your monthly benefit increases by about $38. That does not sound dramatic until you multiply it across a retirement. Over 20 years, that single year of work adds over $9,000 to your lifetime Social Security income. Replace 3 zeros, and the math triples. This applies to anyone who took a career break, started a business, and went without a salary for a few years, stayed home to raise children, or simply entered the workforce later than most. If you are in your late 50s or early 60s and you know you have fewer than 35 years on record, every additional year of earnings you add is pushing a zero out of the formula and replacing it with real money. One important note: if you are married and your own benefit is lower than 50% of your spouse's primary insurance amount, you may qualify for a spousal benefit instead. In that case, working additional years may not move the needle enough to matter, because your benefit is being calculated off your spouse's record, not yours. That is worth checking before you make a decision about working longer solely to fill the gap. Strategy 3, replace your weakest years with stronger ones. This strategy applies even if you already have 35 years on record, and it is the one most people in their late 50s and 60s overlook completely. Social Security always picks your 35 highest earning years. Always. Which means if you are still working and your current income is higher than what you earned early in your career, every year you work now is quietly pushing one of those weaker years out of the formula and replacing it with a stronger one. Here is what that looks like. Say one of your earlier indexed years and the formula shows $30,000. You are earning $90,000 today. That new year replaces the old one, and your average indexed monthly earnings rises by roughly $143 a month. Run that through the formula at the 32% tier, and your monthly benefit increases by about $46. That is $550 more per year for the rest of your life from one additional year of work. Stack 3 or 4 years like that and the total starts to move meaningfully. 2 things worth knowing about this. First, only earnings up to $184,500 in 2026 count toward the formula. Anything above that cap is not taxed for Social Security and does not help your benefit. Second, Social Security recalculates your benefit automatically when you file your tax return, even if you are already collecting. So if you are working part-time in your 60s and those earnings are higher than what you made in your 20s, that year quietly swaps into the formula and your check adjusts upward, often without you ever noticing, unless you compare 2 January statements. The action here is simple. Log in to SSA.gov, pull up your earnings history, and look at your lowest years in the 35-year window. If your current income is higher than any of those, every year you continue working is replacing a weaker year with a stronger one. And unlike the other strategies, this one does not require you to wait or delay anything. It is happening right now if you are still earning. Strategy 4, coordinate your spousal benefit. Think as a couple, not as 2 individuals. If you are married, your Social Security decision is not just about your own check. It is about 2 checks, and the order and timing of when each spouse claims can change the total income your household receives by thousands of dollars a year for the rest of both of your lives. Here is how it works. If one spouse earns significantly more than the other, the lower earning spouse may be eligible for a benefit equal to up to 50% of the higher earning spouse's primary insurance amount. But that full 50% only applies if the lower earning spouse waits until their own full retirement age to claim. Claim earlier and it gets reduced, just like any other early filing. Now, here's the piece most couples miss entirely, and it is where the largest money sits. When one spouse passes away, the surviving spouse receives the higher of the two benefits, not both, just the higher one. Which means the amount the higher earning spouse locks in by delaying is not just their benefit, it is the benefit the surviving spouse will live on, alone, for potentially the next 10, 15, 20 years. Put real numbers on that. Say the higher earner delays to age 70 and locks in a benefit of $3,100 a month. The lower earner claimed earlier at 62 and receives $1,200 a month. When the higher earner passes, the surviving spouse steps up from $1,200 to $3,100 permanently, inflation adjusted, for the rest of their life. That is a $1,900 per month difference in the surviving spouse's income, and it exists entirely because of when the higher earner chose to claim. The strategy most financial planners recommend, and the one that works for a wide range of couples, is for the lower earning spouse to claim earlier, bringing some income into the household during the delay period, while the higher earning spouse waits as long as possible to maximize the survivor benefit. It does not work for every couple. Health, age gaps, and individual circumstances matter, but the principle underneath it is universal. Do not make this decision alone. Sit down with both statements in front of you and think about it as a team. Now, everything we have covered so far, delaying, filling the 35-year window, replacing weak years, coordinating spousal benefits, all of it only works correctly if the numbers going into the formula are right. And this is where most people have never looked. SSA earnings record errors that silently reduce your check, the spousal filing trap that costs families thousands when the order is wrong, both are laid out step by step in the Senior Money Defense Playbook. If either one applies to your situation, catching it before you file changes the math permanently. Link is in the description. Now let me show you the fifth strategy, the one I told you to stay for. Strategy 5. Check your earnings record for errors, because this is the one that can cost you money every single month for the rest of your life without you ever knowing it happened. Everything I have shown you in this video, the 35-year average, the bin points, the progressive formula, all of it runs on one set of numbers, your earnings record. The Social Security Administration keeps a record of every dollar you earned in every year you worked, and that record is what the entire formula is built on. If a year is missing, if a year shows lower earnings than what you actually made, that error flows through every step of the calculation and quietly reduces your benefit permanently. And here is what most people do not realize. The Social Security Administration itself has acknowledged that there are billions of dollars in reported wages that were never properly matched to the correct individual's earnings record. Billions. Not because anyone stole the money, because an employer misspelled a name, because a social security number was entered wrong on a W-2, because someone changed their name after marriage and the old records never connected to the new one, because a small business closed and the payroll records went with it. The result is the same in every case. A year that should show $45,000 shows zero, or shows $22,000 instead of $52,000. And because Social Security averages your best 35 years, that error does not just affect 1 year. It drags down the average that your entire benefit is built on for the rest of your life, and nobody at Social Security is going to call and tell you there is a problem. The only person who can catch it is you. Here is exactly what to do, and it takes about 20 minutes. Go to SSA.gov, create a My Social Security account if you do not have one already, log in, and pull up your Social Security statement. Scroll to the section that shows your earnings history every year you worked, with the amount Social Security has on record for that year. Now look through it carefully. You are looking for 3 things. First, any year that shows 0 when you know you were working. Second, any year where the dollar amount seems significantly lower than what you actually earned. Third, any gap in the record that does not match your memory of your work history. If you want to be thorough, and if this is money you are going to collect every month for the next 20 or 30 years, thorough is worth 20 minutes. Pull out an old tax return or a W-2 from any year that looks off and compare it directly. If the numbers do not match, you have found an error that is actively reducing your benefit. To get it corrected, contact Social Security with the documentation, a W-2, a tax return, or a pay stub from the year in question. The further back the error goes, the harder it can be to locate the paperwork, but corrections have been made on records going back decades when the right documentation exists. And here is the key point about this strategy that separates it from every other one on this list. You do not have to wait for anything. You do not have to delay a decision. You do not have to work another year or coordinate with a spouse or choose a claiming age. You can do this today in one sitting for free, and if you find something, fixing it raises your benefit for life. Now let me bring all 5 strategies together into exactly what to do this week. First, if you have not yet claimed and you are healthy with other income sources to bridge the gap, seriously consider delaying your benefit past your full retirement age. Every year of delay to age 70 adds approximately 8% to a check you will collect for the rest of your life permanently, inflation adjusted. Run the numbers at both ages before you decide. Second, check how many years are in your earnings record. If you have fewer than 35, every additional year of work you add pushes a 0 out of the formula and replaces it with real earnings. Even 1 year can add thousands of dollars to your lifetime Social Security income. Third, if you already have 35 years but your current income is higher than what you earned early in your career, know that every year you continue working is replacing a weaker year with a stronger one. Log in to SSA.gov and compare your lowest year in the formula to what you earn now. Fourth, if you are married, do not make your claiming decision alone. Sit down with both Social Security statements. The higher earning spouse delaying to 70 does not just increase their own check. It increases the survivor benefit the remaining spouse will live on for the rest of their life. Think about this as a team decision, not 2 separate ones. Fifth, log in to SSA.gov this week and review your earnings history year by year. Look for any year that shows 0 when you were working, any year where the amount seems too low, and any gap that does not match what you remember. If something looks wrong, gather whatever documentation you have and contact Social Security. That correction raises your benefit for every month you collect it for the rest of your life. Now, strategy 5, the earnings record error, is the tip of something larger. There are several other numbers inside the Social Security system that can silently reduce what reaches your account every month. An IRMAA surcharge based on income you no longer have. A withholding setting that sends money to the IRS a full year before you owe it. A spousal filing sequence that costs a surviving spouse thousands when the order is wrong. Every one of those is in the Senior Money Defense Playbook, with the exact form, the exact phone number, and the exact step. If even one of them applies to your situation, catching it before the formula locks in changes the math permanently. Link is in the description. One honest note before we close. Everything in this video is general education, not personal, legal, or financial advice. Your Social Security benefit depends on your specific earnings history, your specific filing age, and your individual circumstances. Always confirm your situation directly with the Social Security Administration or a qualified financial professional before making claiming decisions based on anything covered here. Now, here is what I want you to do with this. Think of one person who has looked at their Social Security statement and thought the number was lower than it should be. A spouse, a neighbor, a friend who mentioned they were disappointed with what Social Security was going to pay them. Send them this video. 5 levers, 5 ways to move that number, and the 5th one takes a single afternoon and costs nothing. You might be the reason someone catches an error that has been quietly costing them money for years. Subscribe to this channel and turn on notifications so the next update finds you before it costs you anything. Thank you for watching. I will see you in the next one.